An initial public offering, or an IPO, is the first time that a private limited company makes its shares available to buy on the public market.
And why do companies go public? Well, for three reasons primarily. The primary reason is, of course, to raise capital, or in other words, money for growth and expansion of the business. A second reason is that it gives an exit event for early investors, employees, and founders of the company. This exit event doesn't mean that they're exiting the company, but it gives them the opportunity to sell some of the shares that they've accumulated over all the years that the company was private. And lastly, one final reason is it can be a great publicity and marketing event for some companies, especially for companies that might not be as well known as, say, the big brand names that you're already aware of, for example, Uber or Airbnb. There's of course many small companies that do IPO, and it's a great way for them to get their brand name out there through the IPO process. I'm Steve.
I'm Cian.
And this is the Learnings Report, a show where we make investing accessible and understandable for everyone.
So, how does a company IPO? It's a pretty complicated process, but we're going to break it down for you now.
So the IPO process is basically four main steps. First and foremost, an investment bank is hired by the private company to underwrite the offering. All that means is the investment bank work with the private company to establish how many shares will be issued, how much of the company will be actually up for sale, what the share price will be, choosing the stock's ticker symbol, etc. Once all this info has been established, the private company will essentially sell its shares to the investment bank. And at this stage of the process, the IPO for the private company at least is kind of complete. They've raised their money and now they can go about looking at growth and expansion. However, the process isn't fully finished. Now that the investment bank has bought these shares from the private company, they of course now want to get a return on their investment. So they go ahead and they find other investment banks, brokerages, institutional investors, and just generally very wealthy investors to go and buy the shares at a premium price.
So okay, that's all well and good, but when can we actually invest in an IPO?
So that kind of brings us to step 4 of the process. And in short, the answer is, unfortunately, not until the very first day of trading. So your broker might offer a facility to subscribe to an IPO, but generally speaking, that option is usually only available to very high value customers as part of that brokerage. So if you think about it, similar to a concert, there's limited tickets available for a concert. So if those concert tickets are in very high demand, lots of people want them, and thus only the people who are willing to spend the most will get access to the tickets. Similar to the IPO process, if you want to subscribe to an IPO using your broker, unless you have a ton of money invested in those accounts already, you're unfortunately unlikely to be able to get access. So this kind of brings us to stage 4 of the process, the first day of trading, and that is when you are most likely going to be able to buy the shares of the company that is IPOing.
But should you actually buy a company in IPO? Perhaps, but tread carefully. Based on the things that we've already talked about, usually there's a lot of hype around an IPO, so this may be reflected in the initial price that people are willing to pay for the company. A company also chooses the time that they want to go public, so if you were a company, you'd probably try and optimize the time that you go public in order to maximize the return. The recommendation is usually to wait a few quarters to get a sense of how the company does post-IPO. If you're really passionate about the company and want to invest on the day of IPO or soon after, we would recommend maybe trying a little amount first and seeing how it goes. Maybe don't add a full position on the company, but add to it gradually over time. So
we've gone through the IPO process, but it is important to mention that an IPO isn't the only way that a company can go public. Two other ways that you can look at are a direct listing and through a SPAC. A direct listing is simply when a company takes its existing shares and lists those directly for sale on a public market without going through the whole process of hiring an investment bank or issuing any new shares. Why would a company do a direct listing? Generally speaking, it's a company that already has a really well-known brand image. So for example, Spotify did a direct listing and Slack did a direct listing. Generally speaking, it's also in the case that the company necessarily doesn't need to raise new capital for the business. They just want to offer a way for employees or early investors to cash out. A SPAC, or a special purposes acquisition company, is another way a company can go public, but we're going to save that one for another video. One final point is that not all companies decide to go public. There are plenty of examples of really large private companies, such as Aldi, Deloitte, and Lidl, who haven't gone public but are still quite large. By staying private, these private companies can avoid the public scrutiny that being a public company means you have to adhere to. Thank you for watching. We hope you now understand what an IPO is and how it happens. Any questions at all, let us know in the comments below. And otherwise, we'll see you in the next one.